Welcome to day 8 of our Christmas countdown series. We stay with international equities but move from China to India. Home to one of the fastest growing major economies and the oft discussed structural opportunity, India is also an equity story that has disappointed more often than not. In absolute terms, the market is flat over the past 1 year and relative to S&P an underperformer over the last 1, 3, 10 and 15-year timeframes. And this is before adjusting for consistent currency depreciation. It's been a combination of factors that have driven this underperformance. And they've ranged from a disappointing earnings trajectory and in recent times, the absence of big listed tech and AI champions, particularly important in a world obsessed with that thing. It's not a surprise, therefore, that foreign investors have been net sellers for the last 5 years. That was then. The question is whether this will be a positive surprise into 2026. To start with, earnings growth this year is trending better, both relative to a particularly weak last year, but also relative to many other major markets. Sectorally, cyclical sectors, banks, automobiles, infrastructure appear to be beneficiaries of economic expansion underway, especially with inflation not a threat. The bigger opportunity, however, can come from the very factor that has led to the underperformance in the past: absence of big tech and AI ecosystem positioning. In effect, a diversifier to the tech-heavy US equity market with lower volatility. Not that a fast-growing economy wants to be positioned as a defensive equity play, but that may well be the driver for outperformance. We continue to like Indian equities structurally. Yes, we haven't lost faith. But it's the ignominy of being an old world index and a quality diversifier that may be the catalyst for performance. This is Sunil Garg from Kenai and Lighthouse Canton.